A quality of earnings report is part of the due diligence in an acquisition or a merger. When you acquire a company, you want confidence in their financial figures. Their financials affect the amount you're willing to pay and whether you even want to go through with the deal. Thus, the buyer, and in some cases the seller, hires a third party to analyze the financial statements of the seller as part of the due diligence. The goal is to understand the extent to which earnings are cash or non-cash, the extent to which earnings are recurring or non-recurring, and the extent to which earnings are the result of aggressive accounting. The buyer wants to know the seller's adjusted EBITDA because valuation is often expressed as a multiple of EBITDA. To determine adjusted EBITDA, a quality of earnings analysis would look for improper revenue recognition, improper capitalization of expenses, unsupported changes to allowance accounts, non-GAAP accounting, changes in accounting methods, policies, and procedures like switching from LIFO to FIFO, or increasing the expected useful life of property, plant, and equipment to stretch out the depreciation. The analysis would also look at whether inventory has been overstated, whether there's a significant amount of related party transactions, whether there are any contingent liabilities, whether any key customers have recently been lost. Anything that might affect the company's EBITDA going forward. If the quality of earnings report finds a significant discrepancy between the EBITDA reported by the seller and the adjusted EBITDA found by the quality of earnings report, then the buyer might choose to renegotiate the price or, worst case scenario, just walk away from the deal. While a quality of earnings analysis typically focuses on earnings, it can also look at free cash flow, customer retention, and working capital. Remember, the management team of the seller has the incentive to make the company look as good as possible because they're trying to sell the company. A quality of earnings report tells you whether the financial situation is as good as the seller says it is. Thus, getting a quality of earnings report is similar to having a mechanic look at a used car before you buy it.